we've barely begun to feel the consequences of the mistakes that the Fed has made. You know, the big mistakes were not raising rates. I mean, they need to raise rates. In fact, they waited too long to raise rates, and they haven't raised them enough. The problem was they cut them so low in the first place, and they left them so low. But that is also part of the problem. We should not allow a government agency, even though technically the Federal Reserve is not a government agency, it's independent, although it doesn't operate independently. But we don't want a group of men in a building, you know, sitting around a table deciding what the interest rate should be. You know, the free market needs to set interest rates. It's a very important price of money. And we don't want governments guessing what the right price is, especially when they have a hidden political agenda that causes them to generally want interest rates to be lower than the market would naturally set them. And whenever you have people fixing prices as opposed to a market discovering a price, you're never going to get the right price. You're either going to be too low or you're going to be too high. And in the case of interest rates, we've been too low. I mean, the rate was at zero for pretty much a decade. There's no way that that was the real rate of interest. That wasn't the rate of interest that the market was going to set if the Fed was neutral and just, you know, stayed out of the way and just let everything, you know, happen. They suppress them. And every time you have the government setting a price, you're going to have negative consequences, usually a surplus or a shortage of something. So if they set a price too low, then there's going to be a shortage. Well, more people are going to want to buy, but there won't be enough product. An example of that would be what we did with gas in the 1970s. The reason that you had these long lines is because we controlled the price. We set caps on natural gas or gas prices. And so instead of just paying a high price, we waited in a long line, right? And that was the price we paid, our time. And of course, we had to ration gas. The market rations it with price. But if you don't let the market ration it with price, then you're going to do it with, you know, a more official rationing. Another example is when they set the price too high, and then you get a surplus. A classic example is the minimum wage. You set a minimum wage, and the price for unskilled labor is too high, and so you get a surplus of unskilled labor because nobody wants to buy it. That's unemployment. Right? So you legislate unemployment into existence when you just pick a wage. If the market was able to discover the wage for unskilled labor, then all the unskilled laborers who wanted to work would have jobs. But the government prevents that from happening with the minimum wage. Now, the higher the minimum wage is set, the more unemployment that is going to result. But when the government fixes interest rates, you're also going to have shortages and surpluses. If you set the rate too low, you're not going to have enough savings. Who's going to want to save when the return is really low? On the other hand, you're going to have an excess amount of borrowing. Everybody's going to want to borrow if they can borrow at a very low rate. And look at the US economy. We're loaded up with debt. We have record auto loans, record mortgage debt, record student debt, record credit card debt. The US government has record amounts of debt. Corporations are loaded up with record amounts of debt. Why do we all have so much debt? Well, because interest rates were too low. And so we had a lot of borrowing that would not have taken place if the cost of money was higher. The flip side, the savings rate is near an all-time record low. Most Americans don't have enough savings just to cover, you know, a few $100 emergency expense that comes up. How did America go from a nation of savers to a nation of profligate spenders? Well, low interest rates. So had we had a market-based rate, we would have a lot more savings, a lot more economic growth and capital investment, and we wouldn't be loaded up with debt, and we wouldn't have had all of these asset bubbles. That's another consequence of keeping interest rates too low. Assets are mispriced. So you get, you know, tech stocks in the stratosphere. Or, you know, cryptocurrencies, or all kinds of crazy things happen in an environment where interest rates are too low. I mean, we saw that with the housing bubble. That wasn't an accident that bubble was inflated. The Fed lowered rates to 1%. That was an unnaturally low rate of interest, and a lot of people took advantage of that cheap money, and they bought houses. We got used to the cheap money, and we did a lot of foolish things as a result of all that cheap money. Like if you're doing a lot of drugs and you're high out of your mind, you're probably going to do stuff that you wouldn't do if you were sober. You'll regret it when you sober up. And as the Fed raises rates, people start to sober up, and and they start dumping a lot of these overpriced assets that they bought during a mania. But rates are going a lot higher over time. The Fed has just begun, and in reality, even though we've had all these rate hikes, interest rates are still below the inflation rate, even the way the government measures it, because the actual rate is quite a bit higher than what the government will admit to through the CPI. But even if you accept the flawed CPI, interest rates are lower. So we're still encouraging people to borrow by providing them with a negative rate. And so rates are too low. Rates need to be positive. The free market would not set real interest rates negative, because nobody in their right mind is going to loan money to get back less than they loan, because all loans have a degree of risk associated with them, and you're not going to risk your money for a negative rate of return. You might as well just keep your money and at least break even, right? But of course, if there is a lot of inflation, then people will look for alternative ways to store their purchasing power, because they can't do it in the currency that's being inflated, so they'll look at alternatives. You need to own assets. When you have a lot of inflation, you don't want to own debt instruments. You don't want to be a creditor, so you don't want to have cash. You don't want to have a CD, or you don't want to have loaned somebody money and they're just going to pay you back the same amount that you loaned. You don't want cash value in an insurance policy or an annuity, because inflation is going to erode away the value. But you also don't want to own highly speculative companies that were bid up in price because of the 0% rate environment we were in. So certain types of assets won't do well during inflation, and those were the ones that were already inflated, that the prices were pumped up by the cheap money, and so they became very overpriced. And so as the air comes out of those bubbles, even in an inflationary environment, the price of those assets is going to fall. So you want to avoid what benefited when rates were at zero. And you want to look at different assets that will provide protection. Because one of the things that inflation does, other than act as a tax for the government, because that's how the government generates the income it needs to pay for its spending. We just had that $1.7 trillion spending bill. Nobody's taxes are getting raised to cover those costs. So everyone's going to pay the cost through higher prices. The government's going to print money and create inflation, as opposed to taxing us and taking our money. They're going to take the purchasing power from our money by putting more money into circulation to pay for these deficits. So the government will benefit, but through that. But also, when you have inflation, you transfer wealth from creditors to debtors, because the people who loaned money, when they get paid back, they're not getting paid back the same value that they loaned. The flip side is the people who borrowed money, when they have to repay the debt, they're not paying back as much value as they originally got. So, if you look at a stock, for example, there are stockholders and there are bondholders. So during inflation, the bondholders lose at the stockholders gain, right? So it's the bondholders' loss is the stockholders' gain. But you don't want to buy a stock that's 40, 50, 100 times earnings, or has no earnings, because then there can be a big loss. But if you buy a real company that's trading at 5 to 15 times earnings, somewhere in there, has a good dividend yield, and they've been around, they're selling products and services that people really need to buy, and they'll keep buying them. And even if the price goes up, they'll still buy. Maybe they'll buy a little bit less, but they're going to keep on buying. They'll give up other things in order to keep buying what you've got. Those are the companies that you want to own, as a way to beat inflation, to have a dividend yield that will rise as fast or faster than your cost of living. And you want to own real things. You want to own commodities. And so gold is one of the commodities that people will own. It's obviously the easiest commodity to own because the storage costs are so low. You can get a lot of value in a small space compared to other commodities. So in highly inflationary times, gold is an instrument of choice, not just for individuals, but for governments. I mean, you can already see that now. Major central banks around the world have been adding to their holdings of gold, which are still relatively low compared to where those holdings have been in the past. So I think central banks still have a lot of gold to buy. But the average investor, particularly the institutions, are way underinvested in gold compared to where they would have been 30, 40 years ago. So there's a lot of room for gold to be purchased by investors, and there's not a lot of gold. So if more companies, more investors, more governments are going to want to gain or increase their exposure to gold, it's only going to be because the price goes way up. It can't happen without prices going up, because there's just not enough gold there to buy at the current price. So the price has to rise.